In today's session, we're going to dive into the world of price action trading. Whether you're a beginner or a seasoned trader, understanding price action can significantly enhance your trading. Because at the end of the day, all of the most popular technical indicators are created based on price. And there are many traders who believe that the only thing that you really need to trade with is just price itself. So let's take a deeper look at price action trading and see how it can give you an edge in the market. Let's begin by understanding what price action trading really means. It's actually quite simple. It's basically the idea of trading naked with no indicators on your charts. This approach is all about keeping it simple, where your trades are based on your direct market observation minus the complex formulas and deep analysis. It's based on the idea that if you have too many technical indicators on your charts, you can convince yourself of any trade to buy or sell. Now, some traders will include candlestick patterns into price action analysis, which I think is fully legitimate. Ultimately, you're just looking at the price movements of the instrument that you're trading, stocks, currencies, gold, Bitcoin, whatever it is, and using that information to make a decision on where it might be headed next. Price action analysis includes understanding and analyzing behavior around certain price levels, behavior around exhaustion points, and so much more. One of the key aspects of price action trading is to identify price action signals or patterns. These are specific formations in the market that experienced traders can spot. They act like clues that can help you predict future market movements. What I find interesting about price action analysis is that it is more intuitive and relies on quick decision making, whereas technical analysis seeks to find order in the market movements by averaging it based upon historical prices or more complex calculations than that. Now, I'd like to talk about the 5 different price action trading strategies. Our first strategy focuses on breakouts. There are many ways to trade breakouts. The most common is to look for consolidation, wait for the breakout, and the buy or sell the retrace to the breakout point. It's not my favorite way to trade breakouts. I prefer to ride a breakout when it happens because I'm much more of a momentum trader. So what I like to look for instead is to wait for a 5-day consolidation, like you can see in this Eurodollar chart. Then wait for a 150% breakout of the 5-day range. In this case, the entire range of the Eurodollar on this chart was about 75 pips. So the following day, we get a 150% breakout move. So I buy with a 60 to 70 pip target for a daily chart. You can see that it consolidates for a few more days and a 1-to-1 target for the first half of the position. And then you can trail the stop to see if you can get more. In this case, the max move for the Eurodollar was approximately 135 pips. Next, let's look at the end of day closes. With end of day closes, what you want to see is a big move in the opposite direction, followed by a close within 10 pips of the higher low, which is basically a reversal pattern. If you're familiar with candlestick patterns, this is called a bullish or a bearish pin. And these are strong signals of a reversal. If you see a bullish pin on the daily chart, what you should be looking for is to buy. If you see a bearish pin on the daily chart, you should be looking to sell. Here's a great example of a bullish pin in dollar yen. And if you bought dollar yen when the daily candle closed, you'd be sitting happy with the next day's 100 pip rally. Our third price action strategy looks at price itself, and more specifically, the round numbers. These are often psychological levels where price can face resistance or support. For instance, an index at 3,000 or a stock at $50 per share. Traders tend to set orders at these round figures, making them crucial points to watch for potential reversals or breakouts. Many currencies love to test round numbers. I'd like to call this the run for the round numbers. This is particularly true of Eurodollar, Pound Dollar, and Dollar CAD. If a currency pair gets close enough, the round number is often tested, even if it ends up being rejected. You can see it clearly in this Pound Dollar chart where the currency pair comes within 20 pips of each of the significant round numbers. It inevitably tests and breaks it, even if it means that's just by a few pips. What's valuable here is that this price action pattern is tradable. You can either buy or sell these currency pairs for a run to the round number, or use this knowledge to set your stops accordingly. If you know that a round number will often be tested, set your stop above it or get out before the round number is tested. I incorporate this technique often in my zip trades. Being keenly aware of how currencies behave near round numbers is a crucial element of hitting our 100 pip a week trading goal. The fourth way to trade price action is to look at swing highs and swing lows. These levels are very important and can act as dynamic support and resistance levels. A key point to remember is that if the resistance level is broken, it is often or will often become the new support level, or vice versa. But failure as swing highs and swing lows are just as important. Take a look at this gold chart. I've circled 1985-88 level in gold, and you can see numerous examples of this. And it is no coincidence that gold rallies have stopped at this level many times. With gold and currencies respecting these levels, we know that they're important. If you're long, get out before that level is tested because there's a greater chance that it'll be rejected than broken. I also use this principle in determining my zip trades, entries, and exits. I always exit ahead of a swing high or swing low, and I never buy into one. Lastly, we want to look at higher highs and higher lows. The most common price pattern is to look for 3 days of higher highs and higher lows, or 3 days of lower highs and lower lows. This is usually a sign that a trend will continue. I've circled the example here in this Australian dollar US dollar chart. 3 days of higher highs and higher lows on the daily chart. If you bought that in the 3 days that followed the higher highs and higher lows, Aussie dollar rallied 150 pips. Price action trading is all about interpreting and understanding market movements through its price. It's a unique blend of instinct and analysis, and understanding price action significantly enhances your trading performance. It's been a key ingredient in my Zip trades. We've just closed out the 6th straight month of Zip profits. We made money 7 out of the last 11 months for nearly 2,500 pips of profits. Like any trading strategy, price action trading demands patience and practice. So keep honing your skills. I hope you found these trading tips helpful. If you want to learn more about my Zip trading strategy, take a look at the description below for a very special discount link. And don't forget to like, subscribe, and click on the bell icon for updates. Until next time, happy trading.